Thank you very much, and good morning, everybody. I'm Pete Butterfield, the CEO, and I'm here online with Andrew Franklin, our CFO, this morning. So, firstly, I hope you're all keeping well, and thank you for attending this analyst meeting. Before we start the presentation, could I just check that you've all got copies of today's slides, and if not, you can find a copy on the investor section of our website. So I'm delighted to be able to share with you our 2020 results this morning, and despite the challenges thrown up by the COVID pandemic, I'm very pleased to report that the business has developed strongly. Robust underlying trading and strong free cash flow have been complemented by a strong underlying development of the business, including great progress with Kelo-Cote, our number one brand, the Nizoral integration now being substantially complete, and the successful completion of our second largest deal ever, with the exciting acquisition of the Amberen brand at the end of the year. Operationally, we're also able to keep product in stock and quickly pivot into remote working, and as a result, and most importantly, we're able to keep our teams across the world safe and well. And today, as always, I'm pleased to be joined by Andrew, who's going to take you through the financial highlights of 2020 shortly. And in terms of the content for today, we have a short presentation for you that you've seen. It takes around half an hour just on the business, and the contents of which are outlined on slide 3. Turning to slide 5, we'll move through the disclaimer and everything. For those of you less familiar with the Alliance story, I won't labour too long on this, but just to let you know, Alliance is an international healthcare business. We're growing quite quickly. We have 80 products around the world, and over the past 5 years, we've grown by around 23% CAGR in terms of revenue. Nearly 3/4 of our revenue now, if you include the Amberen deal, because I think it's sensible to look at that given the timing of that. But if you look at our business, 3/4 of our revenues derive from clinically valuable consumer healthcare products, with the remainder being generated from a range of prescription products, predominantly sold in Europe. We're highly profitable and cash generative with healthy returns and good free cash flow as we choose to outsource all capital intensive activities. In terms of our portfolio, we've seen great growth from our consumer healthcare business at over 29% CAGR, and we'll take you through this business in more depth shortly. Slide 6 outlines our vision and our mission. So our vision remains unchanged, to be a leading international healthcare business built around products that are clinically valuable to patients. And our mission is to create partnerships that unlock potential for brands, businesses, and people around the world. So with that in mind, I'd like to now hand over to Andrew to take you through the highlights of the year from a financial standpoint. Hopefully you're online, Andrew.
I am indeed, Pete. Thanks so much.
Right.
And good morning to everybody. If you'd like to move to slide 8, please. As Pete said, we're very pleased with the strong financial performance of the group, despite the challenges thrown up by the pandemic, with both profits and cash flow being ahead of last year. And we also ended the year with a key acquisition in Amberen. This acquisition, Alliance's second largest, will bring additional scale and focus for operations in the US. Returning to the year, sales were down by only 5% at £137.5 million. Our consumer healthcare brands continued their strong performance, with sales up 1% at £93 million. Key highlights in this portfolio include Kelo-Cote, our scar reduction product, with sales growing 12% at £34.7 million, where we saw further strong demand from China from the second quarter onwards as local lockdown restrictions eased. And also from Nizoral, our medicated anti-dandruff shampoo, whose sales grew 4% to £21 million. And China continues to be an important market for Nizoral and a future growth driver for this key brand. Revenues from our prescription medicines portfolio were £44.5 million, down 14% on last year, as hospitals preserved capacity due to COVID-19. However, we did see a modest recovery in the second half, with revenues up 7% on those for the first half, and we anticipate demand will return as local restrictions are eased and the provision of routine healthcare treatments normalizes. A small margin mix improvement and lower operating costs resulted in an underlying EBITDA decreasing at a rate slower than that of sales at -2%. And after allowing for lower interest and financing costs, PBT was up 2% at £33.5 million, with underlying basic EPS also growing 2% at 5.21 pence per share. We're also pleased to announce that after cancelling the 2019 final dividend owing to COVID, we are proposing a final dividend payment of 1.074 pence per share for 2020, taking the total dividend for the year to 1.61 pence. This final dividend, subject to approval at our AGM in May, will be paid on the 8th of July to shareholders on the register on the 11th of June. Cash flow was very strong, and we generated free cash flow of £34.1 million for the year, with the second half cash flow being significantly stronger than the first half, bolstered by underlying business performance and favourable movements in working capital. Following the drawdown from our existing credit facility to fund the acquisition of Amberen, net debt rose to £109 million at the end of the year. As a result of this acquisition, group leverage increased to 2.43 times, which is comfortably within our covenant limit of 3 times. And in the absence of further acquisitions, we expect leverage to decrease to below 2 times by the end of this year. Moving on to slide 9. As mentioned earlier, our total revenues were down only 5% on last year. Group revenue and profit were minimally impacted by exchange rate movements, with sales benefiting by approximately £300,000 on a constant currency basis. Gross profit decreased by 4% versus the previous year, with gross margin increasing 0.5% to 60.2% of revenue, due mainly to favourable changes in product mix. Operating costs for the period were 4% lower than last year at £42.8 million, due to reduction in spend through the cancellation or deferral of expenditure due to COVID, partially offset by increased marketing costs to support investment in the consumer health brands to drive continued long-term growth. For the year, operating costs as a percentage of sales were in line with that of last year at 31% of sales. Due to the lower operating costs and modest margin improvement, underlying EBITDA decreased by only 2% at £38.6 million and represented 28% to sales, 1% higher than last year's rate of 27%. Finance costs were down 1.3 million at 3.3 million, reflecting both a lower level of borrowings in the year and a reduction in interest rates. And as a result, we delivered an underlying PBT of £33.5 million, up 2% on last year, which translates into a basic underlying EPS of 5.21 pence, 2.4% higher than last year, and diluted EPS of 5.14 pence, up 3% on the prior period. Moving on to slide 10, this shows our balance sheet in summary format, and with our overall net assets increasing by £7 million to £281 million. The key movements in the balance sheet relate to an increase in intangibles of £84 million, due primarily to the acquisition of Amberen, which is partly offset by the annual amortization charge for the prescription medicines portfolio, which is now being amortized over a 20-year period, together with an associated impairment charge, both as announced at half year. A decrease in working capital of £5.4 million, which is made up of a £6 million reduction in receivables, reflecting the timing of sales early in quarter 4 than the period in the prior year, and an increase of £7 million in payables as a result of holding higher inventory and the phasing of payments around year-end. These are partially offset by an increase in inventories of just under £7.5 million, which we tactically provided to mitigate against COVID challenges, particularly during COVID challenges and any disruption in the wake of Brexit. The year-end balance also includes £2 million of Amberen inventories. 2 other points to note. The increase in deferred tax relates purely to the acquisition accounting for Amberen, and the increase in net debt of £50 million follows the drawdown of £83 million to fund the purchase of Amberen. Moving on to slide 11, which shows the cash flow and the net debt movements for the year. Firstly, on the left-hand side, cash flow. Our cash flow for trading was very strong at £46.4 million, which reinforces the very good cash generation of the business. As mentioned, we benefited from positive movements in working capital in the second half of 2020, which we expect to reverse this year and will constrain the level of free cash flow generated in H1. But after taking account of tax, interest payments and CapEx, free cash flow for the year was £34 million, 17% higher than last year. Secondly, net debt and leverage. The right-hand chart shows the movement in our net debt during 2020. We started the year with a net debt of £59 million and a leverage of 1.48 times. In the year, we generated cash from operations of £46 million, and after allowing for outflows for tax, interest, CapEx, and the 2019 interim dividend, our net debt would have been £27 million. We used our existing credit facility to fund the Amberen acquisition, which increased our net debt to £109,400,000 at the end of the year. This increased our leverage to 2.43 times, and we expect leverage to decrease below 2 times by the end of the year in the absence of any acquisitions. I'd like to move now on to slide 12, and I'll finish this section with these charts that show the continued strong progress made by Alliance over the past 4 years. The charts on the top row illustrate an evenly leveraged P&L, with sales, EBITDA and PBT all growing at a 3-year CAGR of between 11 and 12%. And the bottom row, which shows continuing progression, EPS up 9%, dividend up 7%, and free cash flow up 16% on a 3-year CAGR basis. I'll now hand back to Pete, who will take you through the next part of our presentation. Back to you, Pete.
Thank you, Andrew. So in the next section, what we'll do is we'll dig into performance in a little bit more depth. So turning to slide 14, 14 shows the performance of all the 3 main brands, and we'll focus in more depth, obviously, on Kelo-Cote, Nizoral, and Amberen in the following slides. But as Andrew has mentioned, good performance from Kelo-Cote and Nizoral. It's worth also noting that Amberen experienced strong growth throughout 2020 pre-acquisition through new distribution wins and also a product launch as well. And, Kelo-Cote and Nizoral have been driven strongly by the recovery in the Chinese markets, which recovered strongly in the second half of the year. So we'll come to that in a little bit more depth. I think it's worth noting on the right-hand side of this slide the performances of the other consumer brands. Now, within those, we had a mixed performance. And if you look at the 2 of the largest, there were 2 key drivers behind the mixed performance. So it was always going to be a tough year for Vermouth, which is our treatment for head lice in the US and the UK. So naturally, it had a challenging time. That was down 14% due to basically homeschooling and children not mixing and social distancing. However, it's worth noting that the market actually dropped 28% over the same period. So Vermouth has benefited from further distribution gains at the beginning of 2020, also some refreshed branding, and it's managed to increase its market share, moving to just over 10% from 8.7% a year ago, so a couple of percentage points there in terms of market share. What's happening in that market is key retailers are indicating they're going to pare down some SKUs moving forward, but Vermouth continues to retain distribution in the majority of mass accounts, and it's really well placed for when lockdowns ease over the course of the year. So that is very much a brand with US exposure, also a little bit in the UK, but certainly US is the home market for that. The other couple I want to pull out, one is Macashield, which is our eye care supplement. Now, revenues were down in 2020, although the majority of this impact is due to distributor stocking in Ireland due to Brexit, and also a distributor change in Ireland, which happened in 2019, and that washed out through the course of the year. I'm pleased to say the brand remains in good health, with underlying in-market sales up around 2%. And we've also just launched that brand into China through cross-border e-commerce at the end of the year, and that's beginning to show some very promising results for 2021. So, we look forward to some growth on both Vermouth and Macashield as lockdowns ease and we come out of that. I think it's also worth noting, a high point in that portfolio, which is Ashland Parsons as well. Our teething range, that was up 27%, thanks to both distribution gains and also a new SKU launch. And this is now the UK's #1 teething brand. And we'll talk a bit more about that product development a little later on, and product development in general. As reported, our prescription medicines were impacted a little more, overall down 14%. This was particularly felt in secondary care in the UK and Europe, which is where our portfolio is of prescription medicines, as hospitals preserve capacity for COVID-19. We were, however, encouraged with the way the portfolio began to rebound following the partial lifting of restrictions at the end of the year. So we look forward to restrictions being lifted. Now let's look at Kelo-Cote in a little bit more depth. on slide 15. So, for those of you not aware, Kelacote is a range of clinically valuable silicon-based scar treatments, which we acquired at the end of 2015. Let's start with the market. The market's in really good health, around 330 million ex-factory prices, and that's growing at 6% per annum. Pleased to say the brand has very high awareness and usage in China, which is the world's largest market. So we've broken out the markets for you there in terms of market share. And it's those top 10 markets that are really driving growth. China, we estimate, has a growth of 18% CAGR as a market. So it's one of the fastest growing. And in 2020, we expanded our cross-border e-commerce offering. We believe that there's significant opportunity to continue to benefit from the positive demographic trends of a rapidly growing middle-class population, rising demand for cosmetic procedures, and also C-section births. So we're very, very nicely positioned in many of those markets, and we think there's a significant benefit to drive growth through there. And as such, we increase our potential sales up to 75 million up to 2025 through a combination of both market growth, increasing presence through cross-border e-commerce, some great distribution partnerships, and also introduction of new product development, which is well underway. So quite pleased with the way Kelacote has weathered the storm, and there's more to come from Kelacote moving forward. On slide 16, we turn to Nizoral. Again, for those of you unaware, Nizoral is a ketoconazole-based medicated anti-dandruff shampoo that we acquired from Johnson & Johnson in June 2018. Again, performed well despite COVID, predominantly down to two factors. Doing very well in China, and also we've managed to launch our first line extension, a new formulation which has been launched successfully in China. I mentioned that back in September. That's generated over £1 million of sales in the first few months in that territory, which is really, really promising. I'm pleased to say the integration of the brand is almost complete. You'll remember we had a 2-year TSA agreement with Johnson & Johnson for this brand. It has taken a little longer, thanks in no part to COVID, and that's slowing things up a little bit. However, we are almost complete in terms of getting that across the line. So in terms of marketing authorizations, the only significant one left to transfer is China, and the reason for that is China's been through, as a country, a significant overhaul of its marketing authorization system. So we've had to wait for that to become clear before we can complete that. So that should be done by the end of the year. We've signed up every single distributor. All those distribution agreements are now complete. And despite the delay in China, we've developed really strong partnerships with our lead distributor, and it's beginning to show signs of great potential. We've also signed a new and exciting partnership in India, and they're quite encouraged about the potential early signs of growth in this market as well. And our target in terms of medium-term sales potential out to 2025 remains the same. We haven't changed that, 30 million plus for Nizoral, and we'll continue to invest in that brand moving forward. Turning to Amberen, which is on slide 17. This is our newest consumer healthcare product, which we acquired on the 29th of December. Similar magnitude in terms of size to Nizoral, so pre-acquisition sales of around £20 million. And Amberen, again, clinically valuable. It's a clinically valuable treatment for the symptoms of menopause. It's available over the counter in the US, which is its home market. And again, like Nizoral and like Kelacote, Amberen is exposed to a growing market and favourable demographics, with over 41 million women going through the menopause at any time in the US alone. And just to give you an idea of the sort of size of category in the US, it's estimated in terms of menopause supplement to be around $130 million in the US and growing at anywhere between 4 and 6% per annum. The brand has great awareness. The Amberen Orange Box, the menopause relief SKU, occupies the number 1 SKU in the US, which is great, and we'll be continuing to leverage that as we move forward. For those of you unfamiliar with the products under the brand, Ambrin is a proprietary formulation of bioactive antioxidants called succinates with amino acids, minerals, and also vitamin E. It's been launched in the US since 2007, but it only really gained retail expansion in a significant way from 2015 onwards, and has grown very nicely since then. And throughout 2020, before we acquired the brand, Ambrin generated sales of just over 20 million, and that was growing at 17%, thanks predominantly to some good distribution gains and also some strong marketing, of that brand. So it's given us really good value in the US in terms of coming in alongside the Moose, and allowed us to double down in what is the largest consumer healthcare market in the world. And I'm really pleased to report we're making very swift progress with the integration of this brand into Alliance, and that 2021 has got off to a very pleasing start. So, we've extensive rights to the Ambrin brand as well, it's worth saying, and we're also assessing launches into other territories throughout our comprehensive routes to market. So our investment thesis was very much behind Ambrin and in the US predominantly, but there is an opportunity to grow outside of the US market, and we've just received approval for Canada over the last couple of weeks. So plenty to go out with Ambrin, and I think you'll see both market growth, new product development, and some international launches seeing growth from around 20 million today to potentially over 35 million in the next 4 years. So very pleased to get that across the line right at the end of the year. Those are the three main consumer brands that we're going to talk about today. Slide 19, it's slide 18, but 19 in the deck. Just want to turn to our prescription medicines. So as far as our prescription medicines go, as we've highlighted, again, this was a mixed performance across the board, but ultimately down year on year due to hospitals preserving capacity across Europe, where the majority of this portfolio is concentrated. And whilst revenues were also adversely affected by the pandemic due to delays in routine treatment, we do expect demand to return as restrictions are eased. But it's very different depending on which product you look at. So I just wanted to pull two out, and these are two that we selectively promote on a relatively low level, both Hydromol, which is a comprehensive range of emollients, which is prescribed the majority through primary care. Hydromol declined slightly, 6% off last year, but it's actually, again, gained market share and is now the UK's third largest emollient brand, and has started 2021 well. Then we look at Forceval. Forceval is a unique formulation of vitamins and minerals, which for many years has been the mainstay of the NHS's treatment for malnutrition. That actually grew 11% last year, and that remains a significant revenue generator for us. So it very much depends on which product that you look at, and some have grown, others have gone back a little bit. But as Andrew stated, we're really encouraged by the early signs of recovery when lockdowns were eased and back in quarter 3, quarter 4 last year. And we remain well placed when this repeats, hopefully later in this year, and not too long now, we hope. So that's an overview of the main elements of the commercial performance. I now want to turn and talk to you about our strategy and our business. I think it's important that you understand what underpins our growth. And turning to slide 20, there are 4 key elements to our strategy. Firstly, organic growth. Secondly, acquisitive growth. Thirdly, our people and our culture. And finally, our sustainable business practices. And I'll take each of these in turn. So let's start with organic growth on page 21. And there are 3 strands that we're focusing in on to continue the growth from our current portfolio, predominantly in our consumer healthcare brands. The first one's something called marketing excellence. Now, this is a structured, rigorous process that we've rolled out through Alliance over the last 2 years. We have 13 brands that currently fall into this process, which aims to give a deep understanding of our customers, their influencers, and ultimately identifying core insights for the growth of our key brands within the portfolio. The second is developing our innovation capability. I've touched on this in the last 2 presentations, but I just wanted to highlight 3 recent examples of making sure that our brands remain relevant to our consumers. First one is the Ashland Parsons teething gel. It was the first innovation for over 150 years on the brand. You'll be aware of the brand and its powder formulation, but we launched the teething gel formulation in 2019, and that has gained significant market share, which is a real success story for us. Macashield chewables derived from deep consumer insight and direct feedback from customers as an alternative to the capsule formulation. And our latest line extension for Nizoral as well. That's the other one I want to pull out. Triatop, as it's called in China. That's got off to a great start. And these are all homegrown examples of new product development. And there'll be many more of these coming from Alliance moving forward. And we've just hired a new head of innovation and development into the business this year with a key remit to ensure that we continue to harness consumer feedback and use it effectively to develop our key brands efficiently. And then finally, I just want to touch on the recognising the rise of e-commerce within our business. So just to give you an idea of the sort of proportions, e-commerce accounts for around a quarter of our consumer healthcare business. And this year we'll be appointing a head of global e-commerce, along with rolling out a new program to our global marketing teams. That's becoming increasingly important for various different products, certainly as we've gone through COVID as well. So there are three strands there in terms of underpinning our organic growth. If you move to slide 23 in the deck, I also just want to touch on acquisitions as well. Obviously, Amberen was the last one that we did. They are and will be an important element of our strategy. In 2020, we reviewed over 90 different opportunities. COVID stalled the number coming through in the first few months, but by the end of the year, the run rate was back to where we expected it to be. And having reviewed those 90, ultimately, that ended in the Amberen deal for us. We've set out in the table the last 5 significant deals we've done, the price we paid, and we've also stated sales at both the acquisition point and sales for 2020. Now, 2020 will be suppressed somewhat due to COVID, but you can see significant growth from all the deals we've completed in this table, and we hope that Amberen will be no different. I now want to talk to you a little bit more about the business in more depth, turning to slide 23. It really has been a challenging year, but we performed strongly on the people front, I'm pleased to say. We have gained Great Place to Work status at the first attempt in both the UK and China, with a trust index rating of 79%. Now, there are over 10,000 companies in the survey, and to put this into context, we only score 6 percentage points off the 25 companies which are the best of the best across all industries. So to get that on the first pass has been exceptional for us. We've onboarded over 50 new people into the business. We've gained a new office and a new team in LA following the Amberen acquisition. We've managed to stay connected through COVID. We invested significantly pre-pandemic in Microsoft Teams, so that was very much in the way that we work anyway. And we're constantly surveying the team to understand the best ways of working, moving both throughout the pandemic and also moving forward as lockdowns begin to ease. All of this, and we've not made a single redundancy. We've not made use of any government furlough schemes or had to rely on any external sources of finance to get us through this tricky period. On the contrary, our business will exit stronger this year than it went into the pandemic on the people front. So now I'd like to turn to the fourth pillar, which is building a sustainable business. We've touched a little on the people side, so I won't labour on that, but I also want to talk a little about our products and how we do business. So product quality and safety is fundamental to our license to trade, and it's baked in the way we do business. And as a heavily regulated business with a strong pharma heritage, we've been able to leverage this in an ever more highly regulated medical device and OTC segment. Just for example, each year we take around 4,000 calls per year into our medical information team alone, and those are all handled professionally throughout the Alliance estate. Our suppliers are also highly regulated, so we audit them all the time. That said, in 2020 we've also kicked off a comprehensive Know Your Supplier program, using a third-party external agency as part of our efforts to further improve and streamline our supplier management and associated business assurance activities. On leadership and governance in 2020, we rolled out a comprehensive package across the board on business ethics and compliance training. Our board is fully independent. We have also set up a newly formed ESG committee as well. We're upgrading our headquarters at Avonbridge House in Chippenham, looking to both manage our carbon footprint while also continuing to maintain the heritage of an important listed building. And as far as charitable giving is concerned, 2020 needed to be a standout year due to the challenges felt by many as a result of the pandemic. We donated over £150,000 to causes local to our international offices directly affected by the COVID pandemic, some of whom would have struggled to keep going without our donations. Very pleased to say we're also able to help frontline NHS staff in the UK with donations of Hydromol and Lipsil to ease dermatitis associated with the continuous exposure to PPE. So looking back, it's been another very busy year for the business. I'd like to now look forward though and look at the potential within our base business. And slide 26 aims to give a flavour of this. Now, if you take into account the potential of Amberen, Kelo-Cote and Nizoral, and you assume, a reasonable high single-digit growth from our consumer business and low single-digit growth from our prescription business, that would yield you a revenue line of anywhere between 225 and 250 million, from just under 140 million today. So significant growth potential. If you keep the PBT margin similar, that would result in around 50 to 60 million of profit before tax and very, very minimal debt within the business. And that obviously is without factoring in any further acquisitions. So significant runway for growth within the business, 3 key brands that are exposed to strong demographic and are clinically valuable and strong products in their own right. So just bringing the formal part of the presentation to close, summarising on page 28, I think our 2020 results bear testament to the robustness and resilience of our portfolio, our business model and our people. I think noteworthy achievements include the successful completion of the Amberen deal, establishing us firmly in the largest consumer healthcare market in the world, and also our Chinese business continues to perform strongly and has delivered really good growth despite the pandemic, and we've generated very strong cash flow as a result of trading. We now have several large brands in fast-growing markets with favourable demographics, and we expect further strong cash generation by the end of 2020, and I'm pleased to report that 21 has got off to an encouraging start. So that's it for the formal presentation. I'd like to thank you all for listening, and with that we'll hand back to the moderator and open the floor for any questions.
Thank you. If you wish to ask an audio question, you may do so by pressing 01 on your telephone keypad. If you wish to withdraw from your question, you may do so by pressing 02 to cancel. Once again, please press 01 on your telephone keypad. If you wish to ask an audio question, there'll be a brief pause whilst we wait for questions to be registered. Our first question comes from Andrew Whitney from Investec. Please go ahead. Your line is now open.
Morning, Andrew. Ooh. Hi, Andrew. Are you there?
Andrew, could you please unmute your microphone?
Sorry about that. Hi, Pete. Hi, Andrew.
Don't worry, Andrew.
Hi, Andrew.
Just 2 questions from me, please. The first one was on future brand potential, the Kelo-Cote one, 75 million in 2025. I know it only recently, I think, you put it up to 50 million. It's now 75. That feels like Kelo-Cote is going really well. Is there any limitation as to how big that product can get? It's exposure to a growing Chinese market. What's the art of the possible on Kelo-Cote is one, and could there be later upside pressure to that 75 million is one question. And then on the other question, 3/4 of your products in that consumer health bucket, and that's got slightly different dynamics to the prescription medicine portfolio. Will the consumer health products ultimately just dilute out the prescription medicines piece? And are you the right at some stage? Will you be the right owner for those two different buckets of products?
Yeah, both very good questions. So let's take them in that order, Andrew. I think Kelacote itself obviously has had a very good year despite the pandemic pressure. The market dynamics are favourable for Kelacote, and it surpassed all expectations when we acquired it. So, we had a business of around 7 million when we acquired it in 2015. So, and we said, look, we aimed at 20. Obviously, that's gone up to 30 to 50 to 75. We genuinely see good potential through both our partnerships, but also through cross-border e-commerce channels into China. The market's growing itself, so it's growing within China at around 20% per annum. So, very, very strong growth out there. And we feel that we like to set ourselves realistic targets as well. So we feel 75 million is the right target for now, and we're that's very much what we're going to be aiming for. And I think we've seen some really good take up on cross-border e-commerce as well as domestic sales through our partner out there. So the demographics are right, the product's right. We've got some good new product development coming through too. And also it's growing in other areas of the world as well. So it's not just about China, we have good exposure in Indonesia and India, Germany. So, these markets are also growing too. So, yeah, it could be a significant value driver for us in the future. And then in terms of the prescription medicines, and are we the right owner for those? Categorically, at the moment, yes, we are. They are, they're brands that we have worked with for several years. And, I think they will return to, a decent sales line this year as lockdowns are lifted. But in terms of the portfolio mix, what's happened simply is the consumer healthcare business has grown very well, and we've just done another consumer healthcare acquisition. And if you look at the last 5 on that chart, you'll see the last 5 have all been bar Amatop, which is a smaller prescription medicine. They've all been consumer healthcare brands that we've managed to grow very, very well. But the concentration of that portfolio is very much UK and a little bit of Europe. So we've got very good coverage there and the skill set to run those. So right now that portfolio is very valuable to us.
Fantastic. Thank you. Thanks for answering
Thank you.
the questions.
Thank you. Our next question comes from Charles Weston from RBC. Please go ahead.
Morning, Charles.
Good morning. Thanks for taking my questions. And I'd like to point out to everyone on the call that Andrew now owes us all a beer for leaving himself on mute. The 3 questions. First of all, on Kelacote, please. H1 and H2 performance was obviously quite different. Should we be thinking about H2 as a base level for 2021, or were there one-off issues in H2 like stocking issues? And on the subject of Kelacote, in terms of that 75 million target, is there anything we should be thinking about in terms of the shape of that? Are there any specific catalysts that could set things up? Given that had one A and B, shall I just leave you with that to start with?
Yes, fine. In terms of specific catalysts, there's nothing in there that we're not doing already. I think good brand management, good distributor management as well. Working in cross-border too has been something that channel is growing very nicely, and we're very nicely placed. And actually with cross-border, we're starting to use that in other areas of our portfolio as well. We just launched Macashield through that quite recently. There are no specific catalysts or any launch event or anything like that. It is simply doubling down on what we're doing now. In terms of H1 and H2, I don't have those splits in front of me. So Andrew, do you have your figures there for H1 and H2 for Kelacote?
For Kelacote, we can certainly see Kelacote growing in the second half in this year, 2021. I don't have it exactly by H1, H2 at this point. So that will be one of the key areas that we're growing in for 21 over 20. But also you've got in there coming now is Amberen. So we'll get the full year impact of Amberen too, which wasn't in the prior period.
Thanks. Sorry, just to clarify, what I meant there is in 2020, you did sort of 14 million in the first half and over 20 million in the second half. So just thinking of the base for next year, in terms of the seasonality of that product.
Understood, Charles. Understood. So for the first half of the year clearly was suppressed due to COVID in Asia Pacific and China. So you started to see that unwinding a little bit in the second half. I think in terms of guidance and where that's going this year, we would hope to see that trajectory continue into 2021. China's rebounded very, very well domestically and also cross-border. So, that is a key, as you can see from the slide, it's 25% of the global market, but also growing quite nicely too. So, yeah, we do see that coming through into 2021.
Thank you. Second question on prescription medicines, actually something perhaps a little bit similar. Again, you saw a step up in H2. So should we be thinking about that as the sort of base level of revenues to think about for 2021, that sort of the 23 million you did in the second half rather than the 21 and a bit in the first half? And can you get back to 2019 levels on that prescription medicine bucket?
Yeah, good question. Whether it's 21 or 23, Charles, your guess, not your guess is as good as mine, but it all depends on how lockdowns are easing. We've had a good start to the first couple of months actually here in the UK, and we are starting to see some signs of growth in that portfolio in particular. We, I think, are holding that, prudently at a flat level for this year. It could go up. That's about as much colour as I can give you on that, depending on how things progress. So I don't mean to be unnecessarily vague on it at all. It's simply we can't tell on that. Can we get back to 2019? I think that could be a challenge, but there are some products in there still with some good potential in them, although not as large a growth as the consumer healthcare brands that you see.
Okay, thank you. My last question is on the acquisitions. Of the 90 M&A opportunities you reviewed, how many did you go for?
We went for around 6 in terms of offer stage, and then we got through, I think we had 2 or 3 very, very close at the end of the day. So it's not an unusual run rate for us that. I think on a normal year, whatever a normal year is, we usually screen seriously just north of 100. So we're probably down 20% in what's coming through the pipeline. But you've got to be very careful with that number because it all depends on size and shape and everything else of brands coming through. So, yeah, we're certainly very well placed. Having done 35 deals now in 20 years, it was great to get Amber across the line right at the end of the year. And as Andrew says, we'll get the full benefit of that this year. The integration's going really well as well. That's quite a swift integration process. So very pleased with that.
Great. Thanks very much.
Thanks, Charles. Just check with the moderator. Any more questions coming in?
I think the moderator's disappeared.
Hello. Hi there.
Sorry about that. The next question is Paul Cadden from Numis.
Yeah.
Please go ahead. Your line is now open.
Morning, Paul.
You're not on mute, Paul, are you?
Paul, could you please unmute your microphone?
No, can you not hear me?
Yeah, we can now. That's fine, Paul.
Okay.
We got you.
I think the moderator had muted me. I have 2 questions, please. The first one is just on the kind of organic growth prospects for consumer, and the balance between in-market and sort of cross-border. I mean, how much do you kind of get from expanding into new markets, and sort of how much investment is it taking to kind of expand and then grow? I'm just thinking how you seed your consumer products into new markets and how you might be able to accelerate that kind of sort of organic growth basis.
Yeah.
And then secondly, how do you think about expanding the consumer portfolio? Because you're in dermatology, you're in women's health, and then sort of hair stuff. So do you think about deepening those three categories, or do you think of sort of additional categories on top?
Yeah, great questions as well. Thank you. I think they sort of form a lot of what we talk about in our strategic planning sessions all the time. So I think let's take the organic growth prospects first. And I think if you look at taking products and internationalizing in general, that is, takes time. It also takes investment to break through into new markets. So, you've got to be realistic about the amount of launch money a distributor is willing to spend based on the type of product and the cut through. That said, with an increasing propensity to move towards e-commerce, it really does mean that you can get quite an efficient cut through with some of the brands without necessarily having significant distributor physical presence and key account managers on the road. I also think it depends on which territory you're going into as well. So it's a bit of a mix, but if I take the last deal that we've done with Amberen, let's take that one. That is a brand which does very well in its home market. We valued it solely on the home market. If we can launch it in 2 or 3 other territories outside of the US, effectively, either through a distributor or ourselves here, for instance, in the UK, that becomes very, very effective for us because it's the type of brand that does very, very well online. But I think, if you're looking at, geographic expansion of all these consumer brands into other markets, that's a difficult ask. And I think where we seem to win and where we do win well are those brands that have already been launched in territory, and we can provide some more focus and some more marketing expertise behind them. So that was the sort of first question. I've now, Paul, forgotten the second question, which was
the sort of breadth of consumer products.
Okay.
And I've been told off. I should have said scalp health instead of hair
rather
stuff.
than hair stuff. Yeah. Sure. I think actually for us, as we've always said, the channel is very, very important. So rather than doubling down on a therapy area, there is undoubted synergy that you can gain, but it depends on the product. So if you're talking about dermatology, for instance, that can be a very, very wide range of products. They don't all necessarily sit alongside each other. So I think you've just got to be quite careful of, trying to buttonhole us with niche us into a particular therapy area. We've always been relatively agnostic with that. Where we're seeing synergy, though, is in terms of channels. So for Bomoose, for instance, and with Amberen, very, very similar call points in terms of bricks and mortar distribution. Pleased to say we've inherited a terrific sales network with the Amberen team as well, which really bodes well for the future. So that using that infrastructure has been great. And as we build out into the US, we hope the next deal that comes on top will be even more synergistic. Then in the APAC region, we have a great business in Kelo-Cote. We also have a very nice business in Nizoral, but it's spread across different regions. And I think, for us right now, we're looking also in Asia Pacific for brands to complement both Nizoral and Kelo-Cote as well. So I think it's not quite necessarily as easy as doubling down on a therapy area, which would be the traditional pharma way of looking at things. This is more a consumer healthcare model where channel is very, very important. Expertise of growing brands online, key account managers, seeing the same buyers. Those are the sorts of things that we're looking to leverage.
Excellent, guys. Thank you very much.
Thanks, Paul.
Thank you. Just as a quick reminder, if you wish to ask an audio question, please press 01 on your telephone keypad. Once again, please press 01 on your telephone keypad if you wish to ask an audio question. Our next question comes from Edward Thompson from N+1 Singer. Please go ahead. Your line is now open.
Morning, Edward.
Morning, Peter. Morning, Andrew. Thank you for taking my question. Two, if I may. Just on you focus on the digital channel and particularly the e-commerce and how it came through in 2020. I was just wondering how much of the business now, particularly the consumer healthcare brands, is sold through the online channel, and then can you just talk through some of the benefits maybe on margin on that, and whether that is likely to continue in 2021 and into 2022, or will you see a more normalization and move away from those online platforms in the years ahead?
Yeah, good question. I think just to answer the sort of numbers question, around the consumer healthcare sales that we are in charge of directly, it's around 25% goes through e-commerce. If you look at the business as a whole, it's about 17%, just due to the sizes of the relative parts of the business. In terms of margin upside, I think it depends on the product, but generally we do tend to get slightly better margins going through the e-commerce route. If you look at our margin mix within the business as a whole, and you look at the shift in the portfolio, we're actually gaining better margins than ever before with our consumer healthcare strategy on the top line, certainly in gross margin terms. So I think, again, it's important to recognise that. Last year, without doubt, COVID has accelerated a few trends that were already coming. So this isn't just a 2020 thing that we've been working on. It's been coming into our business as early as sort of 2010, 2012, when we started with some consumer healthcare brands. But it really accelerated over the last year with brands like Macashield in particular. That's now over 30% sales online, which is, that really has changed. And I think we'll see how things happen again when lockdowns sort of get lifted. And I think you look at a brand like Vamoose, though, that's a kind of distressed purchase, and that's about 3% online. And with Amberen, the last deal that we did, that's running at about 20-25% online. And that's been an area of growth as well. So it's in that sort of area. Bricks and mortar is still really, really important to us. Pharmacist recommendation as well does play a part in what we do, although increasingly we're able to reach the end user. So it's a mix depending on which product, but certainly it's an increasing element that we need to focus even more on. And we're, as I say, just hiring our new head of e-commerce to join the business. So yeah, it's an exciting time, and it's great to be able to reach the consumer directly as well.
And then two questions also. One on, obviously it was a difficult year for the prescription medicine business on the whole in 2020, but with a little bit more headroom on your facility and the strong cash flow, would you potentially see maybe doing some deals to just supplement that side of the business, small bolt-ons, just to add cash flow generative products, or do you think that would be a distraction with the integration going on?
Yeah, I think you've hit the nail on the head in terms of our priorities. We're pretty clear on what we need to do as a business, and certainly in the first half of this year. So it's important that we operationalise our and bring in the biologics business and the Amberen team, and that's going really, really well. Continuing to roll out a lot of new programs within the business, investing in the consumer healthcare brands, so all the marketing excellence, digital excellence stuff that we're doing. We've got much more product innovation coming through as well. And I think in terms of new deals coming through, we've got a great deal flow coming through. We are focusing really on augmenting our consumer healthcare brands in those three markets of the US, Europe, and Asia Pacific and China. So that's very much where we're looking at the moment, doubling down on those. Again, due to those channel synergies and the growth opportunities that are there. But I must add, they must be clinically valuable for a start, and have some form of USP that we can get behind, and I'm pleased to say that's the case with all our main brands at the front end. So I think we're only 2 months after 3 months now after the Amberen deal. That's going very well, as I said. And towards the second half of the year, we'll be looking at things again and see where that takes us.
And then thanks. And then just last question, quite quick, just on Kelo-Cote in India, and just I'm interested to know what presence you already have in the region or in the country, and where you see that market could potentially grow to, either driven by Kelo-Cote or with the products.
Yeah, we haven't given any guidance on India specifically. I think it's fair to say with Nizoral and also Kelo-Cote, when we brought them on, they were quite small markets, but we have managed to secure a very good distribution partnership out there that has started, pretty promisingly for us for both Kelo-Cote, but also for Nizoral as well. We think that there's a lot more potential to go with for Nizoral. Now, our marketing insight, we've done quite a lot of research in India, shows quite a lot of consumer frustration with the treatments that are out there. In terms of hair loss, actually, from itching and scratching due to dandruff, that is a key consumer insight and something that we're working on with our new partner. So it's early days with that partner, but we see some good potential in that market, Ed, and it's something we'll run through a distributor. So we're not about to set up our own affiliate there anytime soon, and it will be a distributor-based model, but good potential, good growth.
Okay, brilliant. Thank you, and well done on the results.
Thank you, Ed.
Thank you. There appears to be no further questions, so I will hand back to the speakers for any other remarks.
Well, look, thank you everybody, as always, for joining. Hopefully that was comprehensive enough for you. I think we've covered pretty much everything in the business. But if you have any further questions, as always, you know where Andrew and I are, and we look forward to speaking with you again soon, and hopefully before too long, seeing you in person. And that's it from Andrew and I.
Thank you.